So in this question, we're going to look at Autumn 18 question 3, question on cost of capital and again, weighted average cost of capital. This is a very common question. I don't think there's any Camp 1 finance paper that doesn't have a Wacc question or some element of Wacc on it. And what you see in this paper, Autumn 18, it came up as the optional question, question 3. Oftentimes it can come up in question 1 and 2 as well, where it's the compulsory questions. You need to know Wacc very well. 20 marks, which is about 30 to 35 minutes of your time in the exam. The examiner here has split it down that there essentially has been calculate the cost of each of the following: cost of ordinary shares, preference shares and bonds, 4 and 3 is 7 marks, and then calculate the Wacc, 5 marks. In other exam questions, just watch it, they'll just say calculate the Wacc and there'll be 12 marks for it. The examiner is just breaking it down to the steps here, but you should know the steps that you have to deal with each source of finance individually anyway, before you deal with the weighted average overall. And they bring it in a bit more of a complication. Then they say they're looking to finance a new project entirely with a bank loan, and they want to calculate the impact that will have on the Wacc of Gates, and also discuss whether or not you believe it's appropriate for Gates to use the weighted average cost of capital to discount the new project. So again, you're just trying to get a more narrative piece. So there's 7 and 4. Sorry, you have 7 and 5 is 12 and 4 is 16 marks for calculations. 4 marks for theory here. So it's kind of a calcs heavy piece. You could have more theory heavy questions as well then. So there's a balance to be done, particularly in the optional questions. So here this company is taking a new project to 3 million and they intend to use the Wacc to evaluate the project. You see you have 3 sources of finances currently. Ordinary shares, and be careful there, that means because there's 50 cent each, there's 4 million ordinary shares. 4 million at 50 cent each is 2 million euro. You have preference shares and you have bonds. And you're given information then about the share price, the dividends, and the information about the other two as well. So it's just important to read through the question initially. Sometimes they'll tell you the amount of source of finance, other times you have to figure out in the question. So essentially what we're working towards then is calculating the Wacc. And we know from doing it in class and from your prior studies, you're going to set up a Wacc table. We're looking at the source of finance. We have ordinary share capital, you have preferences, and you have the bond. And we need to figure out the market value and the cost of each one. So we'll put the cost first, then the market value, and that will get us our weight. And all I do there is working 1, working 2, working 3. So it's a nice, neat, what I call a Wacc table, because you're going to do the weighted average cost of capital. Now, they do ask them individually, but all you have to do is, once you do the whole question, you'll get your marks for point 1, 2, and 3 as well. So you'll see it as a whole question and do it as one, and you'll get the marks for each piece. So we're going to start with ordinary share capital, working 1. And what we need is, we need the market value and we need the cost of equity for the ordinary shares. Right? So it just says calculate the cost. We'll do the market value as well, because that's part of getting your Wacc. You're getting marks for it here as part B anyway. So we're told in the question, the shares are trading at 3.20, importantly here, cum div. What that means, the 3.20 includes the dividend, which is 18 cent. You always want the ex-div price. So your ex-div price here is going to be 3.20 minus 18 cent. So it's going to be 3.02. And that's important, the first thing. And you should have a cheat sheet now, kind of summary study sheet to help you along. There's only a certain amount of source of finance that are examinable. Have those little tips there. You have to use the ex-div price. And that is 3.20 minus 18 cent. Right, so that means we can calculate our market value because we know the number of shares are 4 million. And how we know it's 4 million is if there's 2 million ordinary share capital and each share is worth 50 cent, there must be double the amount of shares, 4 million shares. So that means 4 times 3.02 is 12.08 million, the market value of equity. And you put that in. So I'll do the market value here in euro millions, 12.08. Well, that's your first marks on the board. You always want the ex-div market price. Right. To get your cost of equity, there's always 2 ways to do it. And you should have a summary sheet of the key formulas done out to help you when you're studying. Of course, you can't bring it in on the day of the exam. It's a closed book exam, but it will help you remember what the key information is. So to get the cost of equity, there's two approaches. There is either using CAPM, the capital asset pricing model, but we've no information about risk-free rates here. We've no information about betas. What we have information about is dividends and growth rates. So in this case, you're going to use the dividend valuation model. And remember, you are given formulas on the day of the exam as an appendix. So I just took the summer 19 here. And if you go and look at the dividend valuation model, we're looking for with growth, finding the cost of equity. That's the one we're looking for. The cost of equity equals the dividend today, which is 18 cents, times 1 plus G. In this question, they made it easier. They gave you G directly. You maybe have to calculate G. And there's two ways to calculate growth. You have to go back and look at those. There's the G equals B times R formula, or there's looking at the historic growth rate of dividends. In this question, they've simplified it. They've given you the 5%. And we also know the price is 3.02. You always use the ex-div price. So I'll snip that and I'll bring it in, just to make it easier. We have it in Excel. We'll bring it into our Excel and we'll get the cost of equity then. Make that a bit smaller. So our cost of equity, KE here, is going to be equal to 0.18 times 1.05 divided by 3.02, which is the updated price, plus 0.05. So there's a nice logic to it there. You have your formulas, so there should be no excuse not to know it. It's just a matter of picking out the right information. So that means going to be and that should get you a cost of equity, KE, just put it in percentage form, of 11.3%. Just make sure you work out that, make sure you know how to do the formulas, that you don't mix up the calculation. But your cost of equity there, 11.3%. And we're using there the dividend valuation model. Formula is given to you in the exam appendix. And that's our first source of finance complete. We got the cost and we got the market value. So what you might do now is pause it, see can you do the next one. And you should have a little summary sheet of how do I get the market value for preference shares, how do I get the cost. So use a little summary sheet as you go along. So working 2 then, we're told about the preference shares. You're told they currently trade at 94.25 cents. Dividends are due to be paid shortly. That means that 94.25 is a cum div price as well. So the cum div price is 94.25. The ex div price, just be careful now, the ex div price half year is going to be paid shortly. Preference shares are 8.5% and the nominal value is €1. That means a full year's dividend would be 8.5 cents, i.e. 8.5% of the nominal amount. So a half year will be 4.25. So that's going to be 94.25 minus 4.25. So it's going to be 90 is your ex-div price. Just watch for that in the question. They said a half year's dividend is due to be paid shortly. And to get the cost of the preference shares is equal to dividend divided by price. So here, it's the annual dividend, 0.0885, divided by, just be careful now, 0.9. Because if I'm doing it in euros here, 0.08 of a euro, I'm doing the price in euros here. Or you could also say 8.5 over 90. So just make sure you're consistent on how you present it, either in euros or in pence or cents. So that means the cost there, and I'll put that in percentages. You don't adjust the preference share for tax because dividends on preference shares are not tax deductible. And the cost of your preference there, you can go to 2 decimals if you want, I'll just go to 1, is 9.4%. The dividend over the adjusted price. So I'll put in that, 9.4, and the market value, just watch for it. Your price is 90, And the number of shares, if it's €1 per share, there must be then 1.5 million shares, because there's 1.5 million preference share capital. So what you can do there to get the market value equals 1.5 million divided by 1 times 0.9, because it's trading at 90% of its market value. So 1.5 million times 0.9 is 1.35 million. That is the market value of the preference shares. They're trading at 90% of their par value, or what we call their nominal value. So that is 1.35. I'll just tidy that up so it's the same. 1.35 million. Because I'm doing this in millions, just watch your notation so you get it consistent. The last one then is we have debt, which we call a bond. And in this case, you can have two types of bonds. You can have it irredeemable, in which case it's treated very similar to a preference share because it's not going to be paid back. Or in our case here, they gave us a redeemable bond, and it's going to be redeemable in 2022. Be careful now. This is the end of 17, so year 1 will be 2018. So you have 18, 19, 2020, 2021, 2022. So you're going to have a 5-year payment of interest, so 5 years. And it's going to be trading currently at 96.50 x interest, and all payments have been made. So that's an x interest price. So when it's redeemable, you must use IRR. If it's irredeemable, you can use a shortcut formula like that. But if it's redeemable, you must use IRR. Year 0, you're going to have an outflow of 96.50. I always put the outflows first, makes it more natural to do the IRR. You'll see some exam questions put those as positive and leave the rest of them negative. It doesn't really work like that. You're better off putting the outflow initially negative, then your IRR will work the same. In years 1 to 5, you're going to have interest on a 9.5% bond. Interest is going to be 9.5. So we're assuming the bond's par value is 100. It's either going to be 100 or 1,000. And if the price is 96.50, the nominal value will be 100. So you kind of assume that, you don't necessarily have to be told. And then in year 5, you have to pay back 100 as well, because you're told that they're going to receive 100 back. So that's always your step 1, is list out the cash flows. Step 2 is you adjust for tax, because we know interest on debt is tax deductible. So what we do is we rejig these figures to say it's still 96.50, but this now will be 9.5 times 1 minus the tax rate. So it's going to be 1 minus 0.15. Because technically it's going to cost less to the company because interest on debt is tax deductible. Dividends on preference shares are not tax deductible. That's why you don't multiply by 1 minus t here. So I'll just adjust that. So that's 8.08, and the 100 does not change at the end. So that's your year 0 cash flow. That's your year 1 to 5, and that's your year 5. So we know the cash flows. What we need to do now is get the IRR of that cash flow stream. And if you get the IRR of that stream, that will get you the costs of the debt. So again, my logic always is start at 10%. If you're not given a rate, always start around 10%, and then you can judge whether you need to go higher or lower. Remember, this is always going to be an estimate, so it's never going to be perfect, but you should always be aiming for 1 positive NPV and 1 negative NPV. And then we will use the formula that's given to you for IRR on the day of the exam to finish it off. So there is a nice overlap here with investment appraisal as well. So the 96.50 will always be negative. Will always be the same amount, and it should always be negative. So I'll just put that in brackets, just to make sure we know it's a negative one. That's our 96.50. That's always at its present value because it's at time 0. For the year 1 to 5, some students will have done that individually, 5 separate years. Remember, if you have the same cash flow for 5 years or 4 years, that's an annuity. So if we go to our annuity tables, because we're given those, remember, in your appendix as well. So So you're trying to pick up all these little tips that will save you time in the exam. We're looking for 5 years annuity table, 5 years at 10%, 3.791. So if we multiply 8.08 times 3.791, that will get me the present value of those 5 years of cash flows as a single figure. So it saves you time instead of having to do it yourself. So you multiply the 8.08 times 3.791, and it gets you, we'll just go to 2 decimals because it's a number, about 30.61. And for the final year cash flow, that's a single cash flow, you go to the present value tables, so not the annuity, the present value, and you look at 10% for 5 years, 0.621. So you multiply the 100 times 0.621, and that gets you the present value, I'll do 2 decimals just to be consistent, of the single cash flow today. So your net present value there, I'll just tidy it up, is negative 3.79. So what we can say there, 10%, you have a negative NPV. To find the IRR, we need a positive NPV. So if it was in the exam, you probably go to 5%. Right, I'll just match the solution. The solution went to 7%. Right, but if you went to 5%, you get a slightly different answer, but no problem. You'll still get your full marks because it's only an estimate. Remember here now, how do we know we need to go lower? Well, if you're negative NPV here, we need to go lower discount rate, gets a higher NPV. So if we want a positive NPV, we must go lower than 10%. I go to 7 because I'm following the solution, but if you went to 5% or 4%, that would be fine as well. So the 9650 doesn't change. It's already at its present value because it's year 0. The year 1 to 5 now, it's still 5 years, but you must look at the annuity factor now for 7%. So that is 4.1. So instead of multiplying by 3.791, it's going to be 8.08 times 4.1. And we'll just tidy up those so they're the same format. I'd always go in numbers, I'd go to 2 decimal places unless it's millions. And in numbers, I'd go to 1 decimal place or 2 if you want. And percentages, I go to 2 decimal places. But it's just it's personal preference. It's not a much, don't round to whole figures is the main thing unless you're told to do that in the question. And then the 100 for year 5, I'd go to the present value tables, 7% for 5 years, 0.713. So 100 times 0.713, and you get your present value to be 7.91. And that's exactly what you wanted. 1 negative NPV, 1 positive NPV, and if you went to 5%, that would be even higher still. But what you need to do now is I'm going to show you the formula, which is in this appendix as well, for the IRR. Right, so they give it to you on the day of the exam. Go back to the previous one. There's your IRR, what's called an interpolation formula. So you're estimating, think about it, we know the NPV is going to be 0, somewhere between 10 and 7%. So you're trying to estimate where exactly NPV is 0, because that's what your IRR is. Your IRR is your break-even discount rate. So see, can you pause this now, and can you calculate what the IRR is? And again, use your rule of thumb we would have talked about before. It's definitely between 7 and 10%, and it should be closer to 10%, because minus 3.7 is closer to 0 than 7.9. That's how you can kind of estimate where along that should be. Right. So just take it, try it yourself, pause this now. I'm going to copy it out, and I'm going to bring it into Excel, and we're going to work our way through. Just be careful and use your rule of thumb. If it's not between 7 and 10%, and it's not closer to 10% than 7, you've gone wrong somewhere. So what we're going to do then is our IRR equals 0.07, rate 1 is always the lower rate, plus NPV1, 7.91, times the difference in the two rates, 0.1 minus 0.07, divided by, and this is where you have to be careful, in PV1, 7.91, a minus 3.79 becomes a plus 3.79. So just be careful that you watch for that plus. Minus becomes a plus. That's why we put the negatives first here, because if you did it the other way around, like some solutions do it, you're going to get confused because it's slightly different, the relationship. It's not what you're used to investment appraisal. So stick with the negative first, the positive cash flow second. If you work out that calculation, I'll just do it here. 7.91 times the difference is 0.03 divided by 7.91 plus 3.79. Again, you might have slightly different answers, but you're still going to get the same one. That's going to come to, adding on 0.02, you still add on the rate 1, which I've left to one side. So your IRR here equals 0.07 plus 0.0203, which is coming to just over 9%. 9.03% is your cost of debt. And that is already after tax because you've adjusted for tax already. So watch there, IRR can come up in investment appraisal, or it can easily come up in Wacc as well. And it's an examiner favourite to be examined in Wacc. You'll see all the past papers. There's plenty of them to practice on. So you've got that slotted into your Wacc table, 9.03%. And to get your market value of your bond, you take the par value, which in this case was 2.5 million. You divide by 100, because that's its nominal amount, and you multiply by 96.50, because that's its true price here. So the market value here will be 2.5 million divided by 100 times 96.5. So the market value, when you work it out, is we'll go to, how many decimals do we go to there? 2 decimals, 2.41 million. So that's your market value of the redeemable debentures, 2.41 million. So we'll take that and slot it in. You might have went to thousands, went to more, that's fine. As long as you get very similar answer, allow for rounding, you'll get your full marks. So that's your first key step always in a Wacc. Do them individually and then get the overall weight. So the overall market value of the firm here, 15.84%. And then we get our weightings. 12 over 15. So the majority of this company is financed by equity, about 76%. Small portion is financed by preference shares, about 8.5%. And a small portion then also by the bond, 15. When you tot those up, you get your 100% weighting. So there's always a nice logical steps that you go through. Get your cost, get your market value, get your weight, and then to get your Wacc, it's cost times the weight. So what you're going to be doing here is you're multiplying what portion of the business is financed by here. What portion, 76% of the business is financed at 11%. 8.5% of the business is financed by 9%. So you're just doing the weighted average, taking the weight by the cost, and 15% of the business is financed by 9%. So you can clearly see here, it's going to be between 9 and 11. And because much more of the business is financed at 11%, at the 11%, it's going to be closer to 11. So when you tot those up and you put them in percentages, the Wacc here is about 10.8 or 10.76%. So as long as you did those steps, as long as you're thereabouts, allowing for rounding, that will get you your 12 marks. Right? So that's not a bad 12 marks if you know it. 5 plus 7. But it's about practice. And it's about having how to get each of the individual market values and how to get each of the individual costs off by heart, because you won't have that many formulas in the day of the exam. And remember as well now, so that's 5 and 8, that's 12 marks. You have about 1.5 minutes, a bit more questions. That's about 20 minutes, give or take. Now we've gone about 25 minutes. We've been a bit slower, so you will have to watch your timing in the exam as well. They're also saying they're considering now for Part C financing the entire new project, which is this 3 million, using a bank loan at a fixed rate of 10.2%. What's the impact it will have on the WACC if everything else stays the same? This was quite straightforward if you knew what you were looking at, but quite tricky for students who didn't really know what to do. Essentially what you're doing now is we're going to take this WACC table that we have before, bring it down, and all we're going to do is put in an extra one. So we have our ordinary share capital, we have our market value, right? But we don't know our weights. Because what's happened here is we now have a new bank loan. Its market value is just going to be 3 million. Right, so I'll get rid of those weights a second. Its market value is going to be 3 million because that's the book value that you're putting the investment in. And its cost, just be careful, its cost is going to be 0.102, 10.2% times 1 minus the tax rate. Because remember, if it's a bank loan, interest on debt will be tax deductible. So the actual net cost after tax, if I tidy it up, is 8.67%. But that was a tricky one by the examiner to see did you know what they were asking for. If you bring in a new source of finance, you're just adding on to the WACC table. So you're really restating that table and figuring out will it increase or lower your WACC. And now all you repeat again, you get the market value, which in this case is now gone up by 3 million. And you get your weights. 12 over 18. 1 over 18. Again, I'm just the high level figures. 2 over 18. And finally, the new bank loan, 3 over 18. And when you tot those up, you get your 100%. So the cost and the market values haven't changed. What has changed is there's an extra one in there now. You're assuming its market value is the 3 million given in the question, and that means your weightings have now changed. So you no longer have 76% of equity, you now only have 64. So think about it now before you do the WACC. Make a call in your head. Do you think the WACC will increase or decrease? I'm bringing in a new source of 8.67, cheaper source of finance than the other ones, so this should bring my WACC down. So the cost times the weight for each one, and you tot them up. So the cost times the weight, like we've done before, each one, and you tot them up, and your WACC is now, if I put it in percentages, 10.43. It previously was 10.76 up here, but because I brought in a cheaper source of finance, that is bringing the weighted average down. So that's the benefit of bringing debt into your capital structure. And we covered capital structure in Cap 1 Finance as well. It's lowering your overall WACC. So that's your 4 marks. Bringing in the extra source, restating the table, and getting around 10.43%. Not a bad question if you knew what was required, but a lot of students unfortunately drew a blank there because they weren't exactly sure what was being asked. So make sure you go back and have a look at that. And your last 4 marks then to finish off the 20 marker, discuss whether or not you believe it is appropriate for Gates to use the weighted average cost of capital as a discount factor. All right. Well, there's a couple of key things here. The only time you should use WACC as a discount factor is if the project has the same risk as the business. So does it have the same financial risk? Does it have the same business risk? Because if it doesn't have the same business risk, you're going to a different area or different sector, then the WACC isn't appropriate. It's probably too low. And the other thing to look at is the size of the new investment should be relatively small with respect to the overall business. So you're not going to have a huge change in the overall capital structure. And this 3 million is relatively small with respect to the overall capital structure of the business, which is about 15 or 18. So 15 and then 18 when it's brought on. So the key requirements there, it will be suitable to use WACC as long as the new project is the same type of business risk as the current, it's the same type of financial risk, and it's also relatively small with respect to the overall business. So for example, if you were doubling the business capital invested, WACC may not be appropriate. You'd have to do a bit more of a specific calculation. But you're expecting there probably 3 to 4 decent points to get your 4 marks as well. So I said WACC is a very important area in Cap 1 Finance. I don't think there is any paper that doesn't have cost of capital or a full Wacc question on it. So you need to make sure to go back and practice past papers. This one looked at autumn 18, question 3.